basically dividend traps are stocks that are both cutting their dividends and their stock price is falling as a result. So the market hasn't necessarily expected the cut in dividends, and so their stock price falls. Now, three main factors that can be used to predict dividend traps are basically what is the yield of the stock to begin with. And so in particular, you want to look out for stocks that have a very high yield, particularly those with yields over 10%, because if the stock's paying out more than 10%, then the market's clearly suggesting that that stock, it's not a sustainable yield going forward, or else everyone would be buying that stock and its price would be going up. The second main factor is if a stock price is falling, and this is somewhat related to the first factor in that if a stock price is falling, then that actually causes the yield of the stock to go up. When you look on a historical basis, you look at the last 12 months of dividends divided by the current stock price. So when a stock price is falling, that's generally because the market is telling you that the earnings prospects of a stock is going down. And so when the earnings is going down, then that obviously means the company has less ability to pay out dividends going forward. And so their payout ratio starts to increase, which is the third main factor. And so stocks that have very high payout ratios, they're often not sustainable as well, particularly when they're over 100%, but even as they get up towards 100%. So a great recent classic example of this was AGL, which is on the chart that you can now see on your screen. So you can see at the top left of that chart, you can see the stock price of AGL, which falls strongly during the period. So this is 2021. And at the same time as the stock price is falling, because the historical dividend yield is the last 12 months of dividends divided by the current stock price, you actually find the yield of AGL actually goes up quite strongly. And just before kind of August 2021, you actually saw the yield of AGL get up to almost 14%. And so at that time, if you were kind of an investor that was to look at the historical yield and say, wow, AGL's paying out a huge yield, I should buy into it, that would have actually been a mistake in AGL's case, because AGL then, its earnings were going down because electricity margins were coming down, wholesale electricity prices were dropping, and so that AGL's earnings were dropping, and that actually meant AGL cut its dividends in August 2021 by just over 50%. And so the yield that you thought we're getting was 14%, suddenly turned into 7% at the same time. So its price dropped, the yield dropped as well at the same time, and the amount of capital that you had on your investments continued dropping at the same time. So in our fund, given that we focused on high income and total return, a big part of our strategy is to predict these dividend traps and actually avoid them.